The markets have completely said, we now discredit what you did. And they're basically banking that the Fed will be forced to cut rates massively in short course because the crisis will be so severe that it'll outweigh the risk of inflation.
Concerns in the banking sector, they continue to weigh on global sentiment. Deutsche Bank shares plunging right now. And this also all comes as Treasury Secretary Janet Yellen tried to calm investor fears around the economy.
The latest interest rate hike by the Federal Reserve may be the most important and critical Fed rate hike yet. It's coming at a very sensitive time, and surely a lot of things could go wrong. But how badly would this affect the markets, financial institutions, and the economy? Chamath Palihapitiya answers these questions in this episode. All successful investors rely on getting all the data, news, and information possible to stay on top, and that is why you need to subscribe to the channel now so that you never miss anything. First, Chamath answers the question, was the rate hike needed?
I think that you have two choices. One is you massively let inflation run amok, where you have no tools to fix, or you have massive illiquidity in the financial system, but you actually do have tools to fix that, which is through some combination of quantitative easing and tightening, depending on how much liquidity you want in the system. So I think actually I disagree with Sachs. I think they should have done the opposite. They should have raised 50 bips. It would have created a little bit more chaos in the short term, but it would have set us up to understand what was fundamentally broken and still give the Federal Reserve the ability to use their balance sheet and use liquidity in the future to solve the problem. They took the worst option, which is neither did they cut, nor did they raise enough. And so this problem that Sachs represents actually is the fundamental problem now, which is you won't have enough clarity and signal to really know whether this 25 basis point enough. Look, I've maintained now for 9 months that rates are going to be higher than we like and longer than we want. And so I think it's high time that we acknowledge that we have a sticky inflation problem whose back we have to break. We've known since Volcker era what we need to do that, which is you need to get interest rates to be greater than terminal inflation, which means that a 5% Fed funds rate is insufficient. So we're going to need to see a print of 5.5%, 5.75%. And that's when you're going to have enough contraction, and then the Fed can come back with liquidity. But if they don't take these steps, we're going to be in this very choppy, neither here, neither there situation. And I think that is what causes the real damage, because it's the corrosive effects of uncertainty and what that does to lending, to risk-taking, and that I think is really bad for the economy.
The Economic Policy Institute tweeted that the continued rate hike is going to be bad for the labor market, which is about the only positive aspect of the US economy right now. This would be bad for workers, families, and the economy. And they're not alone. Liz Zelnick, who is Director of Economic Security and Corporate Power at Accountable.us, also believes the rate hike, even though considered small at 0.25%, is still enough to wipe out millions of jobs and send Treasury securities into a nosedive. This isn't just speculation. We're already seeing Treasury yields tank badly. 2-year Treasury yields have fallen to 3.77%, which is the lowest it's been since September of last year. The 10-year Treasury also went down by 9.1 basis points in response to Jerome Powell's speech. Sheila Bair, a former head of the Federal Deposit Insurance Corporation, in an interview said that we need to be more mindful of all unmarked securities at banks, small, medium, and large. There's a growing concern that the banking crisis would spill into other sectors of the economy, so this is much bigger than just banks failing. On the other hand, Larry Summers says the rate hike is appropriate and that the Fed may need to even raise rates much higher than previously expected. He's not alone in his thoughts. Even James Bullard, president of the St. Louis Federal Reserve, also thinks rates need to rise to as high as 5.75%, which is a full 100 basis points from its current level.
This credit bubble is here, and it's being manifested right now in these very sophisticated parts of the market. And eventually, they'll ripple to the broader economy at large. But how a person feels this is they're not going to be able to get a car loan or a mortgage, or the interest rates they pay will go up. And then how bondholders will react to all of this stuff is they'll just start to find different assets, probably the front end of the curve, money market, cash, gold, and they'll just abandon all these assets. And then the other problem is that it's just really, really bad for risk assets. So the things that we invest in, either in a world of inflation run amok because the Fed isn't hiking fast enough, which just destroys future cash flows, or in a world where the Fed pivots in a moment like this, and Nick, you can show the second chart, both result in the same outcome, which is that you just see these massive drawdowns in the value of risk assets. So we're in a really complicated moment. And this is why I think, again, the Fed needed to take leadership this past week and actually do the hard work of either cutting 50 bips or raising 50 bips. And this middle path is the absolute worst path, because trying to thread a needle in this complicated economy, I think, is just going to be impossible. And then what happens is then the markets move around them, right? The markets have completely said, we now discredit what you did. And they're basically banking that the Fed will be forced to cut rates massively in short course, because the crisis will be so severe that it'll outweigh the risk of inflation.
Chamath's concern about credit defaults rising is already playing out. We're seeing increased levels of credit card defaults, and even car debt defaults are on the rise too. Loan defaults had increased from 6.2 from January to February, and is an astounding 33.5% higher than it was last year. Naturally, as the Fed increases its interest rates, banks and credit companies would increase their interest rates too. This would spill over into every credit-related sector of the economy, including mortgages, so we're likely to see a housing market crisis develop as more people struggle to pay their mortgages. The economy is heavily dependent on credit, and when interest rates go up, defaults would rise too. This is never good for the markets and never good for the economy. So could this lead to the Fed easing and changing their policy soon? Chamath thinks so, and believes that we may see the Fed not only pivot on rate hikes, but even begin printing money again.
The reason that we print so much money is sort of what Friedberg says, which is that we just want a well-functioning society. And the simplest and shortest way to do that is to make sure that there aren't any winners and losers anymore. And the most effective way to do that in the markets is with money. Print a bunch of money and there are no more winners and losers. And so everybody can kind of win. Some people may win more, but nobody really ever loses. So I think that's the MO that we're operating under. When you look at how dependent other people, other countries are on the US dollar, in times of stress, they actually become more dependent. And that has a lot to do with their borrowing patterns, the amount of dollars central banks need outside the United States. And so what did you see in a moment of stress? Actually, the Fed opened up swap lines to all the central banks that they work with, their most important operating partners, so Europe, Canada, Japan, etc., Switzerland. And they moved the liquidity window from weekly to daily, and they pounded the swap lines. So I don't know. I think that most people that kind of like, it's like a boy crying wolf. Maybe at some point somebody will be right, but you're going to lose so much money trying to take a point of view around this topic that it's more practical to just look at dollar flows. And dollar flows go up in moments of stress, not go down. And they go up in a distributed manner across the monetary plumbing of the world.
Eventually, the Fed would still have to print money, as that's the only way out eventually. But for now, Jerome Powell is doubling down and saying he's unlikely to cut rates this year. But what about you guys? How are you bracing up for the likely impact this rate hike would have on the markets? And of course, if you enjoyed this video, show us by hitting that like button and subscribing to the channel.